Before we get started, it's crucial to state that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The strategies and information discussed in this presentation are based on extensive research and experience, but they do not constitute professional financial or legal advice. You should always consult with a qualified, licensed professional to discuss your own specific situation before making any insurance decisions. You know that feeling? That email notification pops up from your auto insurance company. It's that time of year again. You click it open, you hold your breath just for a second, and you start scrolling down past all the corporate fluff. And there it is, the number, your new 6-month premium. And it went up. Again, for absolutely no reason. You haven't had a ticket in years. No accidents. You didn't buy a new Ferrari. Your car is a year older, it's worth less, yet somehow you're expected to pay more. You feel that hot flash of frustration, that sense of being completely powerless. You think to yourself, is this just inflation? Is this just the cost of driving now? The answer, and the reason you need to listen to every word of this guide, is a resounding no. That price hike isn't an accident. It's not random. It's a calculated strategy, and your insurance company is betting you'll be too busy, too confused, or too loyal to do anything about it. They're counting on you to just sigh, accept it, and pay it. For millions of Americans, that's exactly what happens. But not for you. Not anymore. Because over the next 10 parts of this guide, I'm going to pull back the curtain on the entire US auto insurance industry. I'm giving you the 2026 playbook. This isn't the same old advice your dad gave you. Shop around once a year, and bundle your home and auto is beginner-level stuff. That's like bringing a butter knife to a sword fight. The game has fundamentally changed. The algorithms that set your rates are now so sophisticated, they're using data points about you that would make your head spin. They know more about your financial habits, your online behavior, and even your psychological profile than you could ever imagine. And they are using that information to calculate the absolute maximum price you are willing to pay without leaving. This guide is your counteroffensive. I'm going to show you how to beat those algorithms at their own game. We're going to expose the hidden factors that are secretly inflating your rates, reveal the secret discounts that agents almost never volunteer, and teach you the exact scripts and negotiation tactics to use to make insurance companies compete for your business, not the other way around. By the end of this, you won't just be saving $100. You'll have the knowledge to potentially slash your bill by 30, 40, or even 50%, saving you thousands of dollars over the coming years. You will understand this system so well that you will never feel powerless in the face of a renewal notice again. So let's start with the single biggest lie in the auto insurance industry. It's the one that costs good, safe drivers like you the most money. It's the myth of the loyalty discount. You've heard it before. Valued customer since 2018. They send you holiday cards. They talk about being a good neighbor. It all builds this idea that the longer you stay with a company, the better they'll treat you, the better your rates will be. That is a dangerous and expensive fantasy. In reality, the industry has a dirty little secret, a term they use internally called price optimization. It has a much simpler name for us, the loyalty penalty. Here's how it works. When you first sign up with an insurer, they often give you a fantastic, super low introductory rate. They might even lose a little money on you that first year. They do this to get you in the door. They know that once you're in, life gets in the way. You set up autopay, you get comfortable, and the process of switching just seems like a massive hassle. You become what they call a sticky customer, and that's when they start to turn the screws. With each renewal, they'll add a small, almost unnoticeable increase. 5% here, 7% there. It's not tied to any new risk you present. You're still the same safe driver. It's tied to their data on how likely you are to leave. Their algorithm has analyzed millions of data points, and it has determined your personal hassle threshold. It has calculated the precise amount they can raise your premium before you'll actually get annoyed enough to go through the effort of shopping for a new policy. Think about that. Your loyalty isn't being rewarded. It's being monetized. They are penalizing you for being a good, stable customer because they know you're a safe bet. The person who switches their insurance every year? They're unpredictable. They're a risk. But you? The loyal customer? You are pure profit. A study by NerdWallet confirmed that loyal customers can end up paying hundreds of dollars more per year than new customers with the exact same driving profile and coverage. It's a system designed to exploit human psychology. We are wired to avoid change and stick with what's familiar. Insurance companies know this, and they have built a multi-billion-dollar pricing strategy around it. So, the very first rule of the 2026 playbook, the foundational principle you must burn into your brain, is this: your current insurance company is not your friend. They are not your partner. They are a business, and their primary objective is to charge you the highest price you're willing to tolerate. Your loyalty is a liability, not an asset. Recognizing this one single truth is the first giant leap toward cutting your insurance bill in half. It's the mindset shift that changes everything. It means you stop thinking, "Why did my rate go up?" and you start thinking, "Who is willing to give me a better deal right now?" This doesn't mean you have to switch companies every 6 months, but it does mean you have to make them believe you will. You have to be in a perpetual state of shopping, armed with competitive quotes, ready to walk away. The moment you stop looking, you start losing. The fear of losing you to a competitor is the only leverage you have, and it is an incredibly powerful one. But to use that leverage effectively, you can't just randomly plug your info into a few websites. That's what everyone else does, and it's why they only get mediocre results. You need a strategy. You need to know where to look, what to ask for, and how to compare the offers you get. And that starts with understanding that not all insurance companies are created equal. They fall into distinct categories, each with its own strengths, weaknesses, and ideal customer profile. Most people start their search in completely the wrong place, wasting hours getting quotes from companies that were never going to give them a good rate in the first place. So now that you understand the why, the loyalty penalty that's been costing you a fortune, it's time to learn the where. In the next part, we are going to break down the 3 secret categories of insurance carriers, and I'll reveal which type is statistically most likely to give you the biggest discount based on your specific needs as a driver. Getting this one step right can save you more time and money than anything else in this process. So let's break down this crucial first step. When you go to buy car insurance, you're not just choosing a company, you're choosing a channel. Think of it like deciding how you want to buy a new TV. You could go to a Best Buy, where a salesperson in a blue shirt only sells you the brands they carry. You could hire a personal tech consultant who scours the entire internet to find the absolute best TV for your specific room and budget. Or you could go directly to Samsung's website and buy it straight from the source. Each path has its own rules, its own advantages, and its own hidden costs. In the world of insurance, these 3 paths are called captive agents, independent agents, and direct-to-consumer carriers. Understanding the fundamental difference between them is the master key to unlocking the lowest possible rate. Let's start with the most traditional route, the captive agent. The name says it all. These agents are captive to one single company. Think of your friendly neighborhood State Farm agent, the local Allstate office, or the farmer's insurance representative you see on a bench at the park. These individuals work for one brand and one brand only. They eat, sleep, and breathe that company's products. Now, what's the upside here? It's a huge one: expertise and service. A good captive agent knows their company's policies inside and out. They know every possible discount, every loophole, and every bundle. If you have your home, your cars, and maybe a life insurance policy, a captive agent can be a godsend. They can orchestrate what's called a multi-line discount that can be truly massive. You have one person to call for everything. Your car gets hit? You call Sarah. A pipe bursts in your basement? You call Sarah. You need to adjust your coverage? You call Sarah. That personal relationship can be incredibly valuable, especially during the stress of a claim. It's the set it and forget it approach. But here's the downside, and it's the reason many people overpay for years without realizing it. A captive agent's primary loyalty is to their company, not to you. They can't sell you a policy from a competitor, even if it's a better fit or hundreds of dollars cheaper. Their job is to sell you the best possible policy within their company's ecosystem. They are not and cannot be an unbiased market shopper for you. So, if their company's rates for someone with your profile, say a 30-year-old male with a new car and 1 speeding ticket, have skyrocketed that year, they can't just turn around and say, "Hey, you know what, Progressive is actually 40% cheaper for you right now, you should go there." They're on one team and they're playing to win for that team. This is perfect for someone who values simplicity and bundling above all else, but it can be a terrible deal if your number one priority is the lowest price on the open market. Next up, we have our second contender, the independent agent, also known as an insurance broker. If the captive agent is the company loyalist, the independent agent is the free agent. They are the personal shoppers of the insurance world. These agents don't work for any single insurance company. Instead, they work for you. They have partnerships or appointments with dozens of different insurance carriers, companies like Travelers, Nationwide, Safeco, and many smaller, regional carriers you've probably never even heard of. When you go to an independent agent, you tell them your story. You give them your driver details, your vehicle information, and what you're looking for. They then take that information and submit it to their entire network of insurance companies, essentially forcing them to compete for your business. Within a day or two, they come back to you with a spreadsheet of quotes from multiple carriers, and they can advise you on which one offers the best combination of price and coverage. The advantage here is obvious: choice. Massive, unadulterated choice. This is where the real comparison shopping happens. An independent agent can often find incredible deals, especially for drivers who don't fit the perfect cookie-cutter mold. Got a speeding ticket? A classic car? A slightly complicated living situation? Independent agents are masters at finding the one niche company that looks favorably on your specific risk profile. Their loyalty is to you, the client, because if they don't find you a good deal, you'll just walk away and they don't make a dime. So what's the catch? First, the quality of the agent matters. A great independent agent is a powerful ally. A lazy one is just a middleman who adds no value. Second, they don't have access to everyone. Specifically, they usually can't quote you prices from the third type of carrier, which brings us to our final contender. This is the one you see advertised 1,000 times a day, the direct-to-consumer carrier. This is Geico, Progressive, Esurance, and Lemonade. Their entire business model is built on one idea: cut out the agent entirely. They believe that by eliminating the middleman and the commissions they have to pay them, they can pass those savings directly on to you. You don't call a local office. You go to their website or use their app. You fill in your own information, you select your own coverages, and a computer algorithm gives you a price in minutes. The primary benefit is speed, convenience, and potentially price. Because their overhead is so much lower, no network of brick-and-mortar offices to maintain, no army of agents to pay commissions to, their baseline rates can be extremely competitive. For a person with a squeaky clean driving record and a standard car, going direct can sometimes yield the absolute lowest price, period. You can get a quote at 2 a.m. in your pajamas. It's fast, it's easy, and it puts you in total control. But that control is a double-edged sword. With a direct writer, you are your own agent. There is no one to guide you. You have to understand what bodily injury liability of 100/300/50 means. You have to decide if you need uninsured motorist property damage. You have to know the difference between collision and comprehensive, and select the right deductible. If you choose the wrong coverage to save a few bucks, there's no expert to warn you that you're leaving yourself dangerously exposed. And when it's time to file a claim, you're not calling Sarah, your trusted local agent. You're calling a 1-800 number and talking to a different person in a call center every single time. For the confident, self-sufficient DIY type of person, this is a fantastic model. For someone who wants advice and a helping hand, it can be a nightmare. So here's the big reveal. Which one of these three paths is statistically most likely to give you the biggest discount in 2026? The secret isn't to pick just one. The secret is to make them fight. The ultimate strategy for finding the cheapest possible rate is a two-pronged attack. First, you must get quotes from the major direct-to-consumer players. Go to the websites of Progressive and Geico. Get your baseline quotes directly from the source. They are in a constant price war, and on any given day, one of them might have the algorithm tilted in your favor. This is your non-negotiable first step and takes about 15 minutes. But do not stop there. Your second step is to contact one highly rated, local independent agent. Just one. Let them do the heavy lifting of shopping their network of a dozen or more carriers that you can't access directly. This is your secret weapon. The independent agent will uncover prices from companies that don't spend billions on advertising. Companies that might offer a fantastic rate specifically for your area or your type of vehicle. By running these two processes in parallel, getting your own direct quotes and having an independent agent shop for you, you create a pincer movement on the market. You're covering the big direct advertisers and the traditional, agent-based carriers. You force the entire industry from every channel to compete for your business. This is how you ensure you are not leaving a single dollar on the table. You are systematically exploring over 90% of the available market with minimal effort. If you have a complex situation like multiple homes and cars, or a less-than-perfect driving record, the independent agent often becomes even more critical, sometimes beating the direct writers by a knockout. But you never know for sure until you check. So now you know where to look. You have your strategic plan of attack. You're going to get direct quotes, and you're going to call an independent agent. But this is like knowing which stores to go to without having a shopping list. Walking in and just saying, "Give me car insurance," is a recipe for disaster. You need to know exactly what to ask for. You need to speak their language. And that's where most people get it dangerously wrong. They focus only on the final price without understanding what they are actually buying. In the next part, we're going to decode the cryptic language of your insurance policy. We'll break down liability, collision, comprehensive, and all the other jargon into simple, plain English. And I will reveal the single most important coverage that millions of Americans get wrong. A mistake that could leave you and your family one bad accident away from total financial ruin. Let's start by picturing a scenario. It's a rainy Tuesday morning. You're running 5 minutes late, the coffee hasn't quite kicked in, and you're thinking about that big meeting at 10. You glance down for a split second to check the navigation, and when you look up, you see nothing but brake lights. You slam your own brakes, you hear the sickening screech of tires on wet pavement, and then that gut-wrenching thud. You've just rear-ended a brand new Lexus. Everyone's okay, thank God. Shaken up, but no serious injuries. But as you stand on the side of the road, exchanging information, a cold dread starts to creep in. This is it. This is the moment your insurance policy goes from a piece of paper you pay for every month to the only thing standing between you and financial disaster. And everything depends on what's written on that paper. So let's pull back the curtain and look at your policy through the lens of this very real, very stressful situation. The first and most fundamental part of any auto insurance policy in the United States is liability coverage. This isn't for you. This isn't for your car. Liability is for them. It's for the person you just hit. It's the coverage that pays for the damage you cause to other people and their property. It's what keeps you from being sued into oblivion. Liability is broken into two key parts. First, there's bodily injury liability. That driver in the Lexus? He's complaining about a sore neck. His passenger is saying her back hurts. They decide to go to the emergency room to get checked out. The ambulance ride, the ER visit, the x-rays, the follow-up with a chiropractor. Who pays for all that? Your bodily injury liability coverage does. It's typically shown as two numbers, like 2550. This is insurance speak that almost everyone misunderstands. The first number, the 25, means your policy will pay up to $25,000 for a single person's injuries in an accident you cause. The second number, the 50, is the total maximum your policy will pay for all injuries in that single accident, no matter how many people are hurt. So if you hit a minivan with a family of 5, your policy will only pay out a grand total of $50,000 for their combined medical bills. The second part of liability is property damage liability. This is the third number in that sequence you often see, like 25/50/25. That last 25 stands for $25,000. That's the maximum your policy will pay to repair or replace whatever property you damaged. In our scenario, that's the Lexus. The crumpled bumper, the smashed taillights, the trunk that won't close. But it also covers anything else you might have damaged. Did you knock over a fire hydrant? Hit a custom-built mailbox? Push that Lexus into a third car? Your property damage coverage is on the hook for all of it, up to that limit. Now here's where it gets scary. Those numbers I just used, 25/50/25, are the state-mandated minimum liability limits in many states. It's the absolute least amount of insurance the law allows you to carry to be considered a legal driver. And here is the dirty little secret of the insurance world. In 2026, buying the state minimum is one of the most financially reckless decisions you can make. Let's go back to our rainy Tuesday. That sore neck for the other driver? A single MRI can cost over $2,000. A few months of physical therapy can easily add up to $10,000. If his passenger also needs care, you can see how you could blow past that $25,000 per person limit in a matter of weeks. And what happens when the bills exceed your coverage? They don't just disappear. The other driver's lawyer will come after you personally for the rest. They can go after your savings, your investments, even garnish your future wages. Your financial life could be upended for years, all because you tried to save a few bucks a month by getting the cheapest legal policy. And what about the car? A brand new Lexus. With its advanced sensors, cameras, and specialized body panels, a seemingly minor rear-end collision can result in a repair bill well over $20,000. That state minimum $25,000 of property damage coverage? It might barely cover it. But what if the frame was bent and the car is declared a total loss? The value of that car could be $60,000–$70,000 or more. Your policy pays its $25,000 limit, and then you are personally on the hook for the remaining $35,000 or $45,000. That's a down payment on a house. That's a college fund. Gone. So far we've only talked about paying for the other guy. What about your car? Your front end is smashed, your hood is buckled, and it's definitely not drivable. If you only have liability coverage, I have some bad news. You get nothing. Zero. Liability is for them. To cover your own car, you need two additional types of coverage, often sold together: collision and comprehensive. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object, whether that's another car, a telephone pole, or a guardrail. It doesn't matter who was at fault. In our scenario, even though you caused the accident, your collision coverage is what will pay to fix your car. Now, this is where we have to talk about your deductible. A deductible is the amount of money you have to pay out of pocket before your insurance company starts paying. Think of it as your share of the repair bill. If you have a $1,000 deductible and the repairs cost $8,000, you pay the first $1,000, and the insurance company pays the remaining $7,000. The higher your deductible, the lower your monthly premium will be, because you're agreeing to take on more financial risk yourself. The lower the deductible, the higher your premium. Finding the right balance here is key to managing your costs. The other half of this duo is comprehensive coverage. I like to call this the acts of God and man coverage. It covers damage to your car from almost anything other than a collision. A tree branch falls on your roof during a storm? That's comprehensive. Your car gets stolen? Comprehensive. You hit a deer on a country road? Surprisingly, that's comprehensive, not collision. Hail damage, fire, flooding, vandalism. All of these are covered under comprehensive. If you have a loan on your car or you're leasing it, the lender will almost certainly require you to carry both collision and comprehensive. If your car is paid off, it's technically optional, but if you can't afford to just go out and buy a new car tomorrow if yours gets totaled, you absolutely need it. Okay, so now you understand the core building blocks. Liability to protect you from lawsuits by covering their damages, and collision and comprehensive to pay for repairs to your car. You understand that state minimum liability is a trap, and you know what a deductible is. You are already ahead of 90% of drivers on the road. But now we come back to the promise I made. The single most important coverage that millions of Americans get wrong. We've built our fortress. We have liability to protect our assets from others. We have collision and comprehensive to protect the value of our own vehicle. We feel safe. But what happens when the roles are reversed? What happens when you're the one sitting at the red light, and someone plows into the back of you? It's their fault, clearly. Their insurance should pay for everything, right? Your medical bills, your lost wages, the repairs to your car. But what if the person who hit you has that same garbage state minimum policy we just talked about? Or worse, what if they have no insurance at all? That's the nightmare scenario. You did everything right. You paid your premiums, you drove safely, and some reckless, irresponsible person slams into you and suddenly, your life is turned upside down. And the person who caused it all, they can't pay. Their insurance, if they even have it, is a joke. A $25,000 policy doesn't even cover the initial ambulance ride and the emergency room visit these days, let alone weeks of physical therapy, lost income from being unable to work, or the chronic pain you might have to live with for the rest of your life. So you're on the hook. You're the one left holding the bag for someone else's mistake. You could try to sue them personally, sure. But let's be honest. If someone is driving around with no insurance or the absolute bare minimum, what are the odds they have $100,000 in assets just sitting around for you to claim in a lawsuit? The odds are effectively zero. You can't get blood from a stone. You're stuck. Financially ruined, potentially. Unless you have the single most important, most underrated, and most frequently misunderstood coverage on your entire policy. It's your secret weapon. It's the coverage that protects you from the massive and growing number of irresponsible drivers on the road. I'm talking about uninsured and underinsured motorist coverage, often abbreviated as UM and UIM. Let's break this down, because understanding this could literally save you from bankruptcy. First, uninsured motorist or UM. This is exactly what it sounds like. It protects you when you are hit by a driver who has no insurance whatsoever. This also, and this is critical, typically covers you in a hit and run. If someone smashes into you and speeds off, your insurance company will treat them as an uninsured motorist. So how does it work? Think of it this way. Uninsured motorist coverage allows your own insurance company to step into the shoes of the person who hit you. They essentially pretend to be the at-fault driver's insurer and pay you for your damages, just as the other company would have if they had been properly insured. This coverage is for bodily injury, pays for your medical bills. It pays for your lost wages because you can't go back to your construction job with a shattered leg. Pays for your pain and suffering. It protects you and any passengers in your car. It is your financial life raft in a sea of uninsured drivers. Now let's talk about its equally important twin, underinsured motorist or UIM. This one is a little more subtle but just as dangerous. This kicks in when the at-fault driver does have insurance, but their liability limits are too low to cover your expenses. Let's go back to that driver with the state minimum $25,000 policy. You're in the hospital, and your total medical bills and lost income add up to $125,000. The at-fault driver's insurance company will cut you a check for their policy limit, which is $25,000. That's all they are legally required to pay. So where does the other $100,000 come from? Without underinsured motorist coverage, it comes from your savings, your retirement account, a second mortgage on your house, or a GoFundMe page your family sets up out of desperation. But if you have UIM coverage, your own insurance company steps in and pays the difference. If you have $250,000 in UIM coverage, they will look at your total damages of $125,000, subtract the $25,000 you got from the other driver, and they will pay you the remaining $100,000. You're made whole. You're protected. Now you might be thinking, okay, that covers my medical bills, but what about my car? It's completely wrecked. This is where it gets a little tricky. UM and UIM in most states are for bodily injury only. To cover your car in a situation with an uninsured driver, you need a specific, separate coverage. It's often called uninsured motorist property damage, or UMPD. Like its bodily injury counterpart, this coverage has your own insurer pay for the repairs to your vehicle when you're hit by an uninsured driver who is at fault. But here's the million-dollar question we get all the time. If I have collision coverage, do I still need uninsured motorist property damage? And the answer is, probably not. Let me explain. Collision coverage pays to repair or replace your car if it's damaged in an accident, regardless of who is at fault. If you hit a tree, you're covered. If you back into a pole, you're covered. And if an uninsured driver hits you, you are also covered. You'll just have to pay your deductible. Uninsured motorist property damage only covers you if you are hit by an identified, at-fault, uninsured driver. It's much more specific. It's also generally cheaper than collision, and often has a lower deductible. So why do I say you probably don't need it if you have collision? Because collision is the comprehensive safety net. It covers you in far more scenarios. UMPD is a limited, less expensive alternative. If you have an older car that you don't carry collision on, then adding UMPD is an incredibly smart, cheap way to get some protection. But if you already have collision, UMPD is mostly redundant. The real takeaway here is not about the property damage part. It's about the bodily injury part. UM and UIM for your medical bills and lost wages. So the next logical question is, how much do you need? And the answer to this is so simple, so logical, it will change the way you look at your policy forever. Your uninsured and underinsured motorist coverage limits should, at a bare minimum, be an exact mirror of your own bodily injury liability limits. Let me repeat that. Whatever amount of coverage you've decided you need to protect your own assets if you hurt someone else, you should have that exact same amount to protect yourself if someone else hurts you. Think about the logic. If you carry $100,000 in bodily injury liability, you have made a conscious decision that it's possible to cause $100,000 worth of damage to another person in an accident, and you want to be protected from that lawsuit. You are protecting your house, your savings, your future wages from being taken by someone you injure. So why on earth would you accept less than that to protect your own family? Why would you value a stranger's health and your financial liability to them more than your own? If you think $100,000 is what's needed to cover a serious injury, you need to have $100,000 of UM/UIM coverage for yourself. If you have $250,000 in liability, you need $250,000 in UM/UIM. It's that simple. To do otherwise is to say, I want to be fully protected if I cause an accident, but I'm willing to gamble with my family's financial future if someone else causes one. It makes no sense. And here's the best part. This isn't some expensive luxury add-on. Uninsured and underinsured motorist coverage is shockingly affordable. We're talking about one of the single best bargains in the entire world of insurance. Because the probability of getting into an accident where the other driver is both at fault and uninsured or underinsured is a smaller slice of the pie. The cost for this coverage is a fraction of what you pay for standard liability. You might be able to add $100,000 or even $250,000 of this life-saving coverage for what amounts to the cost of a few cups of coffee a month. In some states, they are legally required to offer it to you, and you have to sign a form to reject it. Never ever sign that rejection. In other states, it's optional. But it shouldn't be. It should be the first thing you check on your policy. Driving with only liability coverage is like meticulously locking your front door, but leaving every single window in your house wide open. You've only protected yourself from one kind of threat. You've completely ignored the threat that comes from the outside. You've done nothing to protect your own body, your own income, your own family from the consequences of someone else's irresponsibility. So we've established how to protect yourself from other drivers. But what about protecting your biggest asset? What about the car itself? What happens when you are the one at fault, or when a tree falls on your car or it gets stolen? This brings us to the two coverages that everyone thinks they understand but almost everyone gets wrong. Collision and comprehensive. Collision and comprehensive. These two words probably cost you more on your policy than anything else besides liability. Yet they are the source of the most dangerous and expensive misunderstandings in the auto insurance world. Let's break them down because getting this right isn't just about saving money. It's about saving yourself from financial ruin. Let's start with collision. The name is simple and so is the concept, at least on the surface. Collision coverage pays to repair or replace your car after an accident with another object. That object is usually another car, but it could also be a streetlight, a guardrail, a fire hydrant, or your own garage door. The key phrase here is your car. Your liability coverage, as we discussed, pays for the other guy's car when you're at fault. Collision is your safety net for your own vehicle. Now, here's the first place people get tripped up, the deductible. Your collision deductible is the amount of money you have to pay out of your own pocket before your insurance company pays a single dime. Think of it as your copay for a car crash. If you have a $1,000 deductible and you cause an accident that results in $4,000 of damage to your car, you pay the first $1,000. The insurance company then pays the remaining $3,000. This is where the game of cheap insurance gets dangerous. To lower their monthly premium, many people crank their collision deductible up to the max. $1,500, $2,000, even $2,500. They see their monthly bill drop by $30 or $40 and think they've won. But have they? Let's imagine a driver. Let's call him Mark. Mark is a safe driver. He hasn't had an accident in 10 years. He sees his renewal and decides to raise his collision deductible from $500 to $2,000. It saves him about $40 a month. That's almost $500 a year. He feels brilliant. 6 months later, he's pulling out of a tight parking spot on a rainy day. His foot slips, he hits the gas instead of the brake, and he smacks a concrete pillar. It wasn't a high-speed crash, but modern cars are designed to crumple. The bumper is cracked, the quarter panel is dented, the headlight is shattered. The body shop quotes him $3,000 for the repair. Mark files a claim, proud that he has insurance. Then the adjuster reminds him of his $2,000 deductible. To get his car fixed, Mark has to write a check for $2,000 cash. All that savings he felt so good about? It vanished in an instant, and he's still in the hole for over $1,500. He saved $240 over 6 months, only to be hit with a $2,000 bill. The question you have to ask yourself with brutal honesty is this: can you comfortably write a check for your deductible amount right now without causing a financial crisis in your household? If your deductible is $2,000, but you only have $500 in your emergency fund, you don't have insurance. You have a catastrophic bill waiting to happen. A lower deductible means a higher premium, yes, but it also means a predictable, manageable expense if something goes wrong. This leads to the next multi-thousand-dollar question: when should you drop collision coverage altogether? This is one of the most effective ways to lower your premium, but you have to do it at the right time. The general rule of thumb used by financial experts is the 10% rule. If the annual cost of your collision coverage is more than 10% of your car's actual cash value, it might be time to drop it. Let's do the math. Say you have a 14-year-old sedan. You look it up on Kelley Blue Book, and its private party value is about $3,000. You check your insurance policy, and the collision portion of your premium is costing you $400 per year. $400 is more than 10% of $3,000. In this case, you are paying a significant amount of money to protect a relatively low-value asset. If you totaled the car, the insurance company would write you a check for its value, minus your deductible. So, if you have a $1,000 deductible, your maximum payout is only $2,000. You're paying $400 a year to protect a $2,000 risk. It might make more financial sense to drop the coverage, bank that $400 a year in a dedicated car repair savings account, and effectively self-insure. But here's a critical warning. If you have a loan on your car or if you are leasing it, you cannot drop collision coverage. Period. The bank or leasing company that technically owns your vehicle requires you to carry it to protect their asset. If you drop it, you are likely in violation of your loan agreement, and they can take serious action, including force placing a much more expensive policy on your car and charging you for it. Okay, so that's collision. It covers damage to your car from, well, a collision. But what about all the other forms of chaos the universe can throw at your vehicle when it's just sitting there? This is where its partner, comprehensive coverage, steps in. Comprehensive is the everything else policy. It's for damage that isn't caused by a collision. Think of it as the act of God and act of bad luck coverage. A deer jumps out and you hit it? That's not a collision in insurance terms. That's a comprehensive claim. A freak hailstorm turns your car's hood into a golf ball? Comprehensive. A branch from your neighbor's tree snaps off in a windstorm and crushes your roof? Comprehensive. Your car is stolen from your driveway? Comprehensive. Vandalism, fire, flooding, all comprehensive. Many people think, I live in a safe area, my car won't get stolen, or we don't get hail here, so they drop comprehensive to save a few bucks. This is almost always a mistake. First, comprehensive coverage is usually shockingly cheap. For most people, it's a fraction of the cost of collision coverage. You might only save $10 or $15 a month by dropping it, but the risk you're taking on is enormous. Let's think about another driver, Sarah. Sarah lives in a quiet suburb and drives a 3-year-old SUV worth $25,000. To trim her budget, she drops her comprehensive coverage, saving $12 a month. A few months later, while she's at work, a thief smashes her window, rips out the dashboard to steal the infotainment system, and does thousands of dollars in damage in the process. Because she dropped comprehensive, she's on the hook for the entire repair bill. The $12 a month she saved now seems like a cruel joke. Or consider the most common comprehensive claim in many states: windshield damage. A truck kicks up a rock on the highway, and now you have a giant crack spreading across your line of sight. Replacing a modern windshield with all its embedded sensors for safety systems can cost over $1,000. With comprehensive, and especially if you have a specific low or $0 glass deductible, that repair could cost you nothing. Without it, you're paying the full amount. Just like with collision, comprehensive coverage has a deductible. And here is an expert-level strategy that 99% of drivers don't know they can use. You can have different deductibles for collision and comprehensive. And you should. Think about it. A collision is often, to some degree, within your control. You can choose to drive more defensively to be more aware. So, you might be comfortable with a higher collision deductible, say $1,000, to lower your premium, betting on your own safe driving. But a hailstorm, a deer, or a thief? You have zero control over that. Those are random events. For that reason, it often makes sense to keep your comprehensive deductible much lower, like $250 or even $100. The increase in your premium is often minimal, but your protection against random acts of nature and crime is maximized. Ask your agent to quote you a policy with a split deductible. It's one of the smartest moves you can make. So we've covered liability, protecting you from lawsuits. And now we've covered collision and comprehensive, protecting the value of your actual car. We've built the foundation, but we've left out the most important, and by far the most expensive part of any serious accident. We haven't talked about the people. We haven't talked about the medical bills. What happens when you or your passengers are injured? Who pays for the ambulance, the hospital stay, the lost wages? The answer to that is a confusing alphabet soup of coverages: MedPay, PIP, UM, and navigating it incorrectly can be the difference between a full recovery and a lifetime of debt. That's what we need to tackle next. Let's break down that alphabet soup, because this is where a simple car insurance policy transforms from a piece of paper you're forced to buy into a financial life raft that can save you from drowning. Forget the jargon for a second. Let's talk about what actually happens. Imagine you're driving home. It's a Tuesday. You're thinking about dinner. The light turns green, you proceed through the intersection, and then bam! Out of nowhere, A car runs a red light and plows into your driver's side door. The impact is violent. Airbags deploy, glass shatters. The next thing you know, you're hearing sirens. You're in an ambulance, your arm is definitely broken, your head is throbbing, and you're terrified. The first bills start arriving before you're even discharged from the hospital. The ambulance ride alone is $2,000. The emergency room visit, the x-rays, the CT scan, that's another $15,000. Setting your broken arm, another $5,000. And your health insurance? It's a good plan, but you have a $5,000 deductible and a 20% coinsurance after that. So right out of the gate, you owe thousands of dollars, and the physical therapy hasn't even started yet. Who pays for this? The other driver was clearly at fault. Their liability insurance should cover it, right? Yes, eventually. But eventually can mean months, even years of fighting, negotiations, and waiting. In the meantime, those bills are due now. The hospital collections department doesn't care about the other guy's insurance company. They want their money from you. This is the first trap. And the escape hatch is called medical payments coverage, or MedPay. Some states have a more comprehensive version called personal injury protection, or PIP. Think of these as your own personal on-call medical fund for a car accident. It doesn't care who was at fault. It doesn't care if you were the driver, a passenger, or even a pedestrian hit by a car. If you are injured in an auto-related accident, it pays your medical bills right away up to the limit you choose. Pays that ambulance bill. It covers your health insurance deductible. Pays for your co-pays. It's the immediate financial first aid that stops the bleeding while you wait for the larger settlement to work itself out. For a few extra dollars a month, you buy yourself instant peace of mind. In states with PIP, it's even more powerful. Personal injury protection not only covers medical bills, but can also cover a percentage of your lost wages if you can't work, and even essential services like childcare if your injuries prevent you from taking care of your kids. It's mandatory in about a dozen no-fault states, but even if it's optional where you live, it is one of the most valuable coverages you can buy. Skipping it to save $8 a month is like taking the batteries out of your smoke detector to save on electricity. Okay, so you were smart. You have MedPay or PIP. Your immediate bills are getting paid, and you're not getting threatening calls from collections. You're starting physical therapy, but you're still out of work. The other driver was ticketed at the scene. It's an open and shut case. You're relieved. At least their insurance will pay for the rest, the long-term care, the weeks of lost income, the pain and suffering. Then you get the phone call. The call that every accident victim dreads. It's your agent or your lawyer. And they say the words that turn your stomach to ice. The other driver didn't have any insurance. Suddenly, the world drops out from under you. All that money you thought was coming to cover your future? It's gone. It doesn't exist. You can sue the other driver personally, sure. But what are you going to get? A person driving around without insurance probably doesn't have $100,000 in a savings account waiting for you. You can win a lawsuit and get a judgment that says they owe you the money, but as the old saying goes, you can't get blood from a stone. You're left with the broken arm, the mountain of bills, the lost wages, and a worthless piece of paper. This is not a rare scenario. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States is uninsured. That's over 30 million vehicles. In some states like Mississippi and Florida, it's closer to 1 in 4. You are sharing the road every single day with millions of people who are one mistake away from ruining you financially, with zero ability to pay for it. This is why the most important coverage you can have on your policy, arguably more important than even liability, is uninsured and underinsured motorist coverage. UM and UIM. Let's break it down. Uninsured motorist coverage, or UM, is your secret weapon. It steps in and essentially becomes the insurance that the other, at-fault driver should have had. It's a ghost policy that you buy for the other guy just in case. It has 2 parts. Uninsured motorist bodily injury, or UMBI, pays for your injuries. It covers the medical bills that exceed your MedPay or PIP. It covers your lost income. And critically, it is often the only way to get compensation for pain and suffering, the very real non-medical cost of your life being turned upside down. The second part is uninsured motorist property damage, or UMPD. This covers the damage to your car. If an uninsured driver totals your $10,000 car, their non-existent insurance pays you nothing. Your UMPD coverage would step in and write you a check for your car's value. Now, in many cases, collision coverage can also cover this, and we'll get to that. But UMPD often has a much lower deductible, making it a better option if you have it. So that's uninsured motorist. But what about the UM part? underinsured motorist. This is just as dangerous. Let's change the scenario slightly. The guy who hit you does have insurance, but he bought the cheapest possible plan to be legally on the road. In a state like California or Pennsylvania, the minimum bodily injury liability is just $15,000 per person. Your medical bills alone are already past $30,000, and you haven't even factored in the 6 weeks you've been unable to work your construction job. That other driver's cheap policy pays out its $15,000 limit, and that's it. They're done. Their legal obligation is met. You're left on the hook for the rest. This is where underinsured motorist or UIM saves you. It bridges the gap. It takes the amount of your damages, let's say it's $100,000, and subtracts what the other driver's policy paid. In this case, $15,000. Your UIM coverage would then pay you the remaining $85,000, up to your policy limit. Without it, that $85,000 is your problem. When you buy UM/UIM, you choose the limits just like you do for liability. And the golden rule is simple. You should have, at the very minimum, the same amount of UM/UIM coverage as you have bodily injury liability coverage. If you're protecting other people from your mistakes with $100,000 of liability, why on earth would you protect yourself and your family from someone else's mistake with anything less? The cost to increase these limits is often shockingly small, and the protection it provides is monumental. Now for a pro tip that your agent might not even tell you about: stacking. If you have multiple cars on your policy, some states allow you to stack your uninsured motorist coverage. Let's say you have 2 cars and you have $100,000 of UM coverage on each. If you have stacked coverage, you can combine them. So if you're hit by an uninsured driver, you don't just have $100,000 of protection, you have $200,000. For a very small increase in your premium, you can literally double your safety net. Always ask if stacking is available and how much it costs. It is one of the best bargains in all of insurance. So when we talk about finding cheap insurance, this is what we mean. It's not just about the lowest possible number on the bill. It's about value. It's about preventing a $10,000 loss from becoming a $200,000 bankruptcy. Skipping or lowering these coverages to save a few bucks is the ultimate gamble. You are betting that the 30 million uninsured drivers on the road will never cross your path, and that the millions more with barely legal insurance will never make a mistake that involves you. It's a bet that sooner or later someone loses. We've now protected ourselves from the other guy's catastrophic mistakes. But what about our own? What happens if the accident is your fault? Or if there's no other driver involved at all? What if your car gets stolen, or hit by a deer, or smashed by a falling tree branch? That requires a completely different set of coverages designed to protect the investment you made in your own vehicle. That's where collision and comprehensive come in. Let's break them down, because this is where so many drivers get confused, and where you can potentially save or lose a ton of money. Collision and comprehensive are often sold together as a package, sometimes called full coverage. But they are two distinct things protecting your car from different kinds of mayhem. First up, collision. The name says it all. This coverage pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a streetlight, a guardrail, a garage door you misjudged. You get the idea. It doesn't matter who was at fault. If you back into a pole, collision coverage can fix your bumper. If someone runs a red light and T-bones you, collision will pay for your repairs first, and then your insurance company will go after the at-fault driver's insurance to get their money back. It's your frontline defense for accident damage to your own vehicle. Without it, if you cause an accident, you're paying for your own repairs entirely out of pocket. And even if the other driver is at fault, you'd have to wait on their insurance company to accept liability and cut a check, which can take weeks or even months. Collision gets your car in the shop right away. Now, let's talk about comprehensive. This is the everything else coverage. Think of it as protection from acts of God and acts of chaos. Comprehensive covers damage to your car that isn't caused by a collision. This is a huge list. It includes theft. If your car is stolen, comprehensive coverage pays you its value. It covers vandalism. Someone keys your car or smashes a window. It covers fire, floods, and natural disasters like hurricanes or tornadoes. It covers falling objects like that tree branch we mentioned, or a chunk of ice sliding off a roof in winter. And here's the big one for a lot of people: hitting an animal. If a deer jumps out in front of you and you hit it, that's not a collision in insurance terms. That's a comprehensive claim. It's a bizarre but important distinction. So, liability protects everyone else from you. Collision and comprehensive protect your car. Now for the million-dollar question: do you actually need them? Legally, in almost every state, the answer is no. The state government only requires you to have liability coverage to protect other people. They don't legally care if you can afford to fix your own car. But, and this is a massive but, if you have a loan on your car or you're leasing it, the answer is almost certainly yes. Why? Because until you pay it off, you don't fully own your car. The bank or the leasing company does. They have a financial stake in that vehicle. And they are not going to let you drive their multi-thousand-dollar asset around without full protection. Your financing agreement will explicitly state that you must maintain both collision and comprehensive coverage for the life of the loan. If you drop it, they can legally repossess the car, or more likely, they'll buy a policy for you called force-placed insurance at an absolutely outrageous price and tack it onto your loan payment. Trust me, you do not want that. So, the first step is simple: if you have a loan or lease, you need collision and comprehensive. End of story. But what if you own your car outright? What if you drove that 2012 Honda Civic off the lot 10 years ago and have the title free and clear sitting in your desk drawer? Now you have a choice. And this choice is one of the single biggest levers you can pull to control your insurance costs. To make the right decision, you need to do some simple math. You need to know two numbers: your car's actual cash value, or ACV, and the annual cost of your collision and comprehensive coverage. Actual cash value is what your car is worth right now, today, not what you paid for it. It's the sticker price minus depreciation. You can get a good estimate for free from sites like Kelley Blue Book or Edmunds. Be honest about the condition. Is it excellent, or does it have a few dings and 150,000 miles? Let's say your trusty old Civic is worth about $4,000. Next, look at your insurance policy or get a quote. How much are you paying per year specifically for the collision and comprehensive portions? Let's say it's $600 per year. Now, you have to consider your deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company pays a single dollar. It's your skin in the game. Deductibles for collision and comp typically range from $250 to $2,000. For our example, let's say you have a $1,000 deductible. Here's the calculation. Your annual premium for the coverage, $600, plus your deductible, $1,000, equals $1,600. You are paying $1,600 for the potential to make a claim on a car that is only worth $4,000. If you got into a major accident, the most the insurance company would ever pay you is the car's value for $1,000, minus your deductible, $1,000, which is $3,000. Is it worth paying $600 every single year for the possibility of getting a $3,000 check? For some people, it is. They want that peace of mind. For others, that math just doesn't add up. They'd rather take that $600, put it in a savings account, and self-insure. They're betting on themselves to be safe drivers. If they go a few years without an accident, they've saved thousands of dollars. If they do have an accident, they use that savings to either repair the car or, more likely, put it towards a down payment on a new one. A good rule of thumb many financial experts use is this: if the annual cost of your collision and comprehensive coverage is more than 10% of your car's value, you should seriously consider dropping it. In our example, 10% of the car's value is $400. We're paying $600. By this rule, it's time to let it go. This brings us to the second massive lever you can pull: your deductible amount. The relationship is an inverse seesaw. The higher your deductible, the lower your premium. The lower your deductible, the higher your premium. Insurance companies see a high deductible as you taking on more risk yourself, which makes you a safer bet. Someone with a $2,000 deductible is probably going to be a lot more careful about avoiding small fender benders than someone with a $250 deductible, because they know they'll be on the hook for that first $2,000. Jumping your deductible from $500 to $1,000 can often save you 15 to 30% on your collision and comp premium. That's real money back in your pocket every month. The key is to choose a deductible you could actually afford to pay tomorrow if you had to. Don't pick a $2,000 deductible to save $20 a month if you don't have $2,000 in an emergency fund. That's a recipe for financial disaster. But if you do have the savings, raising your deductible is one of the smartest and fastest ways to lower your bill. So let's put it all together. If you're driving a newer financed car, you must have collision and comprehensive. Your path to savings is to choose the highest deductible you can comfortably afford. If you're driving an older, paid-off car, your path to savings is to evaluate its actual cash value. Do the math. Figure out if the premium and deductible are worth the potential payout. If not, you can drop these coverages entirely and slash your insurance bill, sometimes by half or more. It's a calculated risk, but for millions of Americans with older cars, it's the right financial move. Protecting your car's value is critical, especially when it's one of your biggest assets. But protecting your car is only half the battle. What about protecting yourself and your passengers from the frighteningly high number of drivers who break the law and are out there on the road with no insurance at all? That's a nightmare scenario that can leave you with crippling medical bills. And it requires a completely different kind of protection. We need to talk about that next. This is the scenario that keeps insurance agents up at night. Because all the liability coverage in the world, the $100,000, the $300,000, the $500,000 you're paying for, it does absolutely nothing for you in this situation. Your liability coverage is designed to pay for the damage you cause to other people. It is a shield to protect your assets from others. It is not a sword to help you recover when someone else with no assets and no insurance hurts you. For that, you need a different kind of shield. You need your own policy to step up and become the insurance the other driver should have had. This is called uninsured and underinsured motorist coverage. And in 2026, it is arguably the single most important non-negotiable coverage you can carry. Let's break it down. It's actually two separate but closely related coverages. First, uninsured motorist coverage, or UM. This is for that nightmare scenario we just talked about. You're sitting at a red light, you get rear-ended, and the driver who hit you either has a fake insurance card, a policy that lapsed 6 months ago, or they just flat out admit they have nothing. Or even worse, they hit you and speed off into the night. A hit and run. In most states, a hit and run is treated exactly the same as being hit by an uninsured driver. In this moment, your world is spinning. Your car is damaged, your neck hurts, and the person responsible is a ghost. Who pays? This is where your uninsured motorist coverage becomes your financial superhero. It swoops in and pays for your injuries and your passengers' injuries, up to the limits you selected. It covers medical bills, lost wages if you can't work, and even pain and suffering. Think of it this way: your insurance company sues the ghost driver on your behalf, pays you, and then they take on the impossible task of trying to get the money back from that person. You get the protection without the headache. There's also a component for your car, called uninsured motorist property damage, or UMPD. This pays to repair or replace your vehicle if the at-fault driver is uninsured. Now you might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. So why have both? Couple of reasons. First, your UMPD deductible is often much lower than your collision deductible. We're talking maybe $250 versus $1,000. Second, in some states you can't buy UMPD if you already have collision. It's an either-or. But the key takeaway is that UM coverage is there to fix your body and your car when the person who broke them can't. Now let's talk about its equally important twin, underinsured motorist coverage, or UIM. This one is more subtle, and it's a trap millions of drivers fall into. The scenario is almost the same. You get hit. The other driver is at fault. They stop, they're cooperative, and they even have insurance. You breathe a sigh of relief. But here's the problem. They only have the state minimum liability coverage. In many states, that could be as low as $25,000 for bodily injury. Let's say the accident is serious. You need surgery, physical therapy, and you're out of work for 3 months. Your medical bills and lost wages quickly balloon to $90,000. The other driver's insurance company cuts you a check for their policy limit, $25,000. That's it. That's all they're legally required to pay. You are now left with a $65,000 hole, a gap that can lead to bankruptcy. This is where underinsured motorist coverage saves you. Your UIM policy looks at that gap and says, "We've got this." It steps in and pays the difference, that $65,000, up to your UIM policy limit. It fills the gap between the other driver's pathetic coverage and your actual costs. So why is this so critical right now, heading into 2026? Because the number of uninsured drivers on the road is staggering. The most recent data from the Insurance Research Council estimates that 1 in 8 drivers in the United States has no auto insurance. That's more than 12%. In some states like Florida, Mississippi, and New Mexico, that number is closer to 1 in 4. Think about that. On your daily commute, 1 out of every 4 or 5 cars you see in your rearview mirror might have zero ability to pay for the damage they cause. With rising inflation and economic uncertainty, more people are going bare, rolling the dice and driving illegally without coverage. You cannot afford to bet your financial future on the hope that the person who hits you is one of the responsible ones. Now, the rules for this coverage vary wildly by state. About 20 states and the District of Columbia actually require you to carry some form of UM/UIM coverage. But in the other 30 states, it's optional. Your insurance agent might ask if you want to add it, or worse, they might just have you sign a form rejecting it to give you the absolute lowest price quote. Do not reject this coverage. I repeat, even if it is optional in your state, you should treat uninsured and underinsured motorist coverage as mandatory. It is a financial life raft in a sea of irresponsible drivers. So how much do you need? The rule of thumb is simple and powerful. Your UM/UIM limits should mirror your own bodily injury liability limits. If you have decided that you need $100,000 in liability to protect your assets from someone you might injure, doesn't it make sense to have at least $100,000 in coverage to protect your own body and your own family from an uninsured driver? You are protecting yourself to the same degree that you are protecting a stranger. It's the ultimate golden rule of insurance. And here's a pro tip, something many people have never heard of: stacking. In many states, if you have more than one car on your policy, you're given the option to stack your UM/UIM coverage. Let's say you have 2 cars and you have $100,000 of UM coverage on each. If you have an unstacked policy, your limit is $100,000 per accident, period. But if you pay a little extra for a stacked policy, you can combine the limits. In that accident with the uninsured driver, you would now have $200,000 of available coverage. If you have 3 cars, you'd have $300,000. It is an incredibly cost-effective way to multiply your protection, especially for a catastrophic injury. Always ask your agent about the cost difference between stacked and unstacked coverage. It's often surprisingly small for the huge leap in protection it provides. This isn't about being paranoid. It's about being realistic. You can be the safest driver in the world, with a perfect record and a brand new car full of safety features. But you have zero control over the choices of the millions of other drivers sharing the road. UM and UIM coverage is your personal bodyguard. It's the one part of your policy that's exclusively focused on protecting you and your passengers from the worst-case scenario: a negligent driver who can't pay for the damage they've done. The cost for this peace of mind is minimal. We're often talking about the price of a few fancy coffees a month to protect yourself from a 6-figure medical debt that could haunt you for the rest of your life. So we've built our fortress of protection with liability, collision, comprehensive, and now the critical UM/UIM coverage. These are the big 4, the pillars that protect you from financial ruin. But what about the smaller, everyday nightmares? The flat tire on a dark highway? The rental car you need while yours is in the shop for weeks? The brand new car that gets totaled just a few months after you drive it off the lot? These aren't million-dollar disasters, but they are massive headaches that can be solved for pennies. These are the secret weapon add-ons that smart drivers use, and we're breaking them all down next. First up, roadside assistance. We've all seen it. That lone car on the shoulder of the highway, hazards blinking, hood up. And we all think the same thing. Man, I hope that never happens to me. But hope isn't a strategy. Imagine it's you. It's 10 p.m. on a Sunday, you're in an unfamiliar area, and your car just dies. The engine sputters, the lights go dark, and you coast to a stop. What do? You pull out your phone and Google tow truck near me. The first number you call quotes you $250 cash and says he can be there in 90 minutes. Maybe. You're stranded, you're vulnerable, and you're about to be massively overcharged. Now let's rewind. Same scenario, but a year ago when you were buying your insurance, you saw an option for roadside assistance for $3 a month. You thought, why not? And clicked it. Now stranded on that same dark road, you don't Google a tow truck. You open your insurance app, press a single button that says, I need help, and your phone's GPS tells them exactly where you are. 15 minutes later, a certified, pre-vetted tow truck arrives. You don't hand over any cash. You don't haggle. You just sign a form, and you're on your way. You just turned a $250, 90-minute nightmare into a free 15-minute inconvenience. All for less than the price of a cup of coffee each month. That isn't just an add-on. It's buying peace of mind wholesale. Next, let's talk about a different kind of roadside nightmare. The accident is over, everyone is safe, but your car is crumpled. The body shop says it's fixable, but they're backed up. It's going to take 3 weeks. 3 weeks. How do you get to work? How do you take your kids to school? You're now in a terrible position. You have to pay your monthly car payment, you have to pay your insurance premium for a car you can't even drive, And now you have to go rent a car, which can cost $50, $60, even $80 a day. Over 3 weeks, that's over $1,000 out of your pocket. An unexpected gut punch to your budget. This is where another tiny, powerful add-on comes in. Rental reimbursement. It's usually another few bucks a month. But for that tiny cost, if your car is in the shop after a covered claim, your insurance company hands you the keys to a rental. They'll cover, for example, $40 a day for up to 30 days. Suddenly, that $1,000 disaster vanishes. You drop your damaged car at the shop, pick up a rental right there, and your life continues with barely a hiccup. This add-on is the single biggest stress reducer after an accident. It single-handedly prevents a major accident from spiraling into a full-blown financial and logistical crisis. But what if the accident is worse? What if the car isn't just damaged, it's totaled? This is where we enter the most misunderstood and financially dangerous trap for new car owners. It's called the gap. Let's say you just bought a beautiful new SUV for $45,000. You made a small down payment and financed the rest. You drive it off the lot smelling that new car smell, feeling on top of the world. Then 6 months later, a driver runs a red light and T-bones you. The car is a total loss. You're okay, but the car is gone. You file the claim. The insurance company, as we discussed, owes you the actual cash value of the car. Because of depreciation, the value your car loses the second you drive it off the lot. Your 6-month-old, $45,000 SUV is now only worth $38,000. So they write you a check for $38,000. Here's the problem. You look at your auto loan statement, and you still owe the bank $43,000. The insurance check isn't enough to pay off the loan. You are now $5,000 in debt to a bank for a car that is a twisted pile of metal in a junkyard. You have to write a $5,000 check for nothing. This is financial quicksand. This is why gap insurance exists. Guaranteed asset protection. It's an add-on that covers the gap between what your car is worth and what you still owe on your loan or lease. In that scenario, your regular collision coverage would pay the $38,000, and your gap insurance would pay the remaining $5,000. You walk away clean, owing nothing. If you are financing or leasing a car, especially with a small down payment, gap insurance isn't a luxury. It is an absolute, non-negotiable necessity. And a pro tip: it is almost always dramatically cheaper to add it to your auto insurance policy than it is to buy it from the car dealership's finance office, where they often mark it up by hundreds of %. Now let's take that a step further. Gap insurance saves you from debt, but it doesn't get you a new car. Just gets you back to zero. You're left with no car and no money to buy a new one. That's a tough spot. For those who want the ultimate protection on a brand new vehicle, there's an even better option: new car replacement coverage. It does exactly what it sounds like. If your new car is totaled within the first year or two of ownership, the insurance company doesn't just give you its depreciated cash value. They give you the money to buy a brand new car of the same make and model at today's price. So if your 1-year-old car is totaled, they don't give you the money for a 1-year-old car. They give you the money for a brand new 0 miles on the odometer version. It's like a real-life undo button for the worst day of your car's life. It costs more than standard coverage, but if you've just invested a huge chunk of your savings into a new vehicle, it provides a level of security that is simply unmatched. Okay, what about those of you who've put your own money into your car after buying it? I'm talking about the customizers, the enthusiasts. You spent $2,000 on a new set of wheels, another $1,500 on a killer sound system, maybe a custom exhaust or a vinyl wrap. Your car isn't just a car. It's your project, your passion. Then it gets stolen. Or it's in an accident and those custom parts are destroyed. You file your claim and the adjuster says, "I'm sorry, your policy only covers the factory-installed equipment. We can give you the value of the stock wheels and the basic radio, but that's it. All that money you invested, it's gone, vanished into thin air." Unless you have custom parts and equipment coverage. This is a specific add-on that lets you ensure the value of your aftermarket modifications. You declare the value of what you've added, pay a small premium, and if something happens, you're covered. If you have poured your heart and your wallet into your ride, this isn't an option. It's the only way to protect your investment. Finally, let's talk about the add-on that protects your most valuable asset, your low rate. You've been a fantastic driver for a decade. No tickets, no accidents. Your insurance premium is as low as it can be. You are the perfect customer. Then one morning you're backing out of a parking spot, you misjudge the distance, and you put a small dent in someone's bumper. A minor, low-speed, completely accidental fender bender. It's your first ever at-fault claim. When your policy renews 6 months later, you get a shock. Your rate has jumped 35%. Years of safe driving erased by one tiny mistake. This is where the golden ticket of insurance add-ons comes in. Accident forgiveness. Many top-tier carriers offer this, sometimes for free after you've been a loyal customer for a few years, and sometimes as a small, paid add-on. It's exactly what it sounds like. The company agrees to forgive your first at-fault accident. They pay the claim, they fix the cars, but they don't raise your rates because of it. Your perfect driving record, in their eyes, remains intact. It's a get-out-of-jail-free card for your premium. It acknowledges that even the best drivers can have a bad day, and it prevents that one bad day from costing you hundreds or even thousands of dollars over the next 3 to 5 years. These coverages, roadside, rental, gap, new car replacement, custom parts, and accident forgiveness, they aren't just random boxes to check. They are strategic tools. They are the difference between an accident being a minor inconvenience and it being a life-altering financial disaster. They are the fine-tuning that transforms a generic basic policy into a personalized shield designed to protect your specific life and your specific vehicle. But knowing what to buy is only half the battle. Now that you have the perfect shopping list, how do you walk into the store and guarantee you get the absolute best price? How do you leverage everything we've learned into one final, powerful action that forces companies to compete for your business? We've built the foundation, we've chosen the materials, and next we build the skyscraper. The final part is where we put it all together and lock in a rate that will make you wonder why you ever paid $1 more. And that skyscraper building process begins with one simple, powerful action: initiating the quote. This is the moment where all our preparation, understanding our driver profile, knowing our coverage needs, and identifying our potential discounts, gets put to the test. This isn't about filling out one form and hoping for the best. This is a coordinated, multi-pronged strategy designed to create a bidding war for your business. We are going to deploy a 3-wave attack. Wave 1 is the wide net approach. You're going to use an online insurance comparison tool. Think of sites like the Zebra, Insurify, or NerdWallet's tool. Your goal here is not to buy, but to gather intelligence. You'll enter your information once: your car, your driving history, the coverage levels we meticulously defined in the earlier parts. And these platforms will instantly pull quotes from a dozen or more carriers. This is your market survey. You'll immediately see who the major players are in your specific area for your specific profile. You'll get a baseline, a general understanding of the price range you're working with. But do not, under any circumstances, stop here. Many drivers do, and they leave hundreds of dollars on the table. These sites are a fantastic starting point, but they don't always capture every available discount, and the price you see isn't always the final, locked-in rate. Think of this as the aerial photograph of the city. You can see the big buildings, but you don't know what's happening on the ground floor. Now for Wave 2, the direct assault. From your aerial photograph, you've identified the top 3 to 5 most promising companies. These are the ones that came back with the most competitive initial numbers. Now, you go directly to their websites, one by one. You will fill out their quote applications yourself. Why? Because you can be more precise. You can manually ensure every single discount we've talked about is being explored. Did the comparison site ask if you were a member of a specific alumni association or a credit union? Probably not. But the direct application might. Did it ask if you have winter tires or a professionally installed anti-theft device? Maybe, maybe not. When you go direct, you control the data. You will also add 2 more companies to this direct assault: the giants who sometimes don't play on comparison sites, and your current insurer. You must get a fresh quote from your current provider as if you were a brand new customer. The results will often shock you. The loyalty tax is real, and the rate they offer new customers is frequently lower than the one you're paying as a long-term client. As you get these quotes, you need a command center. Open a simple spreadsheet or a notes app on your phone. Create columns: company name, 6-month premium, 12-month premium, liability limits, collision deductible, comprehensive deductible, and a final crucial column labeled Notes. In the notes, you'll jot down the specific discounts they applied or any unique features they offer, like accident forgiveness. This document is your blueprint. It turns a confusing mess of numbers into a clear, actionable battle plan. With your blueprint filling up, it's time for Wave 3, the secret weapon: the independent agent. This is the masterstroke that separates the amateurs from the pros. While you've been tackling the big, direct-to-consumer companies, an independent agent works with a whole different set of insurers. These are often excellent, highly rated regional companies that don't have billion-dollar advertising budgets. They rely on agents to find them good, qualified customers like you. Find a well-reviewed, local independent insurance agent. Call them and say, "I've done my homework. I'm looking for a policy with these specific coverage limits. I've already gotten quotes from the major players. I want to see if your carriers can offer a better value." This is a powerful position to be in. The agent immediately knows you're a serious, informed buyer. They will go to work for you, searching their network for a policy that fits your needs. Sometimes they come back with a knockout price from a company you've never even heard of. Other times they can't beat the direct prices you found, and that's valuable information too. It confirms that your own research has likely uncovered the best possible deal. Either way, engaging an independent agent costs you nothing and adds a powerful layer to your search. Now the skyscraper is framed. Your quote sheet, your blueprint is complete. You likely have 3 to 5 truly competitive final offer quotes. The lowest number is staring you in the face. But we're not done. We still have to install the gold fixtures. It's time to negotiate. Pick the company you want to be with. Maybe it's the one with the absolute lowest price, or maybe it's your current company if their new quote was competitive, or perhaps it's the one with the best customer service ratings. You are now going to make one final phone call. Let's say your preferred company is Progressive, and they quoted you $600 for 6 months. But Geico, your second choice, came in at $550. You call Progressive. You don't need to be aggressive. You just need to be honest and informed. The script is simple. "Hello, my name is your name, and I just completed a quote. Reference number. I'm very interested in moving forward. However, I'm trying to make my final decision. I have a directly comparable quote from Geico, with the exact same coverage limits and deductibles for $550. I prefer Progressive service and would rather sign with you. Is there any final review you can do on my quote to see if you can get closer to that number?" Then you stay silent. Let them work. You have given them all the information they need. You've told them you want to be their customer, you've presented a legitimate, competing offer, and you've asked for their help. 9 times out of 10, the agent will put you on a brief hold and come back with a slightly better offer. They might find an extra small discount that the online system missed. They might be able to apply a new customer or competitive discount. They may not match the price exactly, but they might come back at $560. Now you have a decision to make. Is that extra $10 over 6 months worth it to be with the company you prefer? That's up to you. But you just saved another $40 with a single 5-minute phone call. Before you hang up and agree, you make one last request. "Thank you so much, that's fantastic. Before we finalize, could you just do one last sweep of my profile to confirm every possible discount has been applied? I just want to be sure we haven't missed anything, like a professional organization discount or an anti-theft device credit." This is your final quality control check. It shows you're thorough and it prompts them to do their due diligence, potentially saving you even more. Now you lock it in. You've executed the strategy perfectly. You've forced the market to compete for you. You've leveraged data, used multiple channels, and negotiated from a position of power. The rate you secure today is not the result of luck. It is the result of a deliberate, intelligent process. But the most dangerous moment is right after this victory. It's the moment of complacency. You've got this incredible rate, and you're tempted to set it and forget it. This is the single biggest mistake you can make. The insurance landscape is constantly shifting. New rating factors are introduced, companies change their target demographics, and your own life circumstances change. The perfect policy for you in 2026 might be a terrible deal by 2028. So, here is your final non-negotiable step. As soon as you sign up for your new policy, take out your phone, open your calendar, and go forward 11 months. Create an event. Title it, "Shop for Car Insurance." Set 2 reminders for it. This is your annual financial health checkup. By repeating this process, maybe in a more abbreviated form each year, you ensure that the skyscraper you just built doesn't fall into disrepair. You guarantee that you are always paying the most competitive rate the market can offer. What you've just learned over these 10 parts is more than just a method for finding cheap insurance. It's a system for taking control of a significant mandatory expense. You've transformed yourself from a price taker into a price maker. You've gone from passively accepting a bill to actively dictating its terms. This is a skill that will save you not just hundreds, but likely thousands of dollars over your driving lifetime. You didn't just find a deal. You mastered the game.